I'm Jocelyn, and I'm the APAC Growth Lead from MakerDao. The project was first launched in 2017, and we have also made it to the World Economic Forum's list of technology pioneers for 2020 and Forbes FinTech 50. MakerDao protocol is the creator of DAI stablecoin, a crypto token that is price stable to the US dollars. So one DAI is soft-pegged to $1. It is built on Ethereum blockchain protocol, and the stablecoin is backed by crypto collaterals. We have in total of close to 6 billion DAI in total circulation today and over 1,000 integrations with other decentralized applications in the ecosystem. The thing is, not all stablecoins are created equal. You have fiat-backed stablecoins like USDT, which is Tether, USDC, which is Circle, and Paxos. And then you also have a decentralized stablecoin like DAI, which is fully backed by crypto collaterals. There's no custodians of centralized fiat assets like Tether. All the assets are backing DAI is locked transparently in the smart contracts. Stablecoins are the backbone of DeFi. Without stable assets to use as a store of value, medium of exchange, and unit of count, the ecosystem merely just cannot function. And so how is DAI generated? Anyone can generate DAI through MakerDao. They can lock up their valuable assets, for example cryptocurrencies and tokenized real-world assets, and draw a DAI loan up to a certain limit. For example, if you want to generate a $100 worth of DAI, you need to lock up $150 worth of Ethereum in the smart contracts. So the collateral ratio is 150%. For different collaterals, we have different collateral ratio. And the entire system is over-collateralized. Over-collateralization ensures that in the event of a rapid decrease in asset price, a vault can be liquidated with extra value still to spare. And this ensures that DAI holders can sleep well at night knowing that no matter what happens to the price of the asset backing the DAI, they can always receive equivalent value of the assets backing the DAI in circulation. And another reason why people want to lock up their crypto assets is because they don't want to sell their cryptocurrencies while the market is bearish. So instead, they use Maker protocol as a leverage to generate loans in DAI against their own assets, and use that DAI to pay off their loans or bills or fund their company operations. So getting DAI loans from Maker protocol is somewhat similar to getting a mortgage from the banks. The only difference here is that we are not going through the banks, but the smart contract itself. And as a user, you need to have a high level of accountability and responsibility yourself, because you're not dealing with any intermediaries here that can help you to, navigate. And so what happens when the price of underlying assets falls too low? A vault is automatically liquidated if the collateral value falls too low. And then part of the collateral is then auctioned off by the protocol to cover the outstanding debt and penalty fee. And then DAI is then burned by the protocol to decrease the supply. What happened is that vault owner will at the end receive the leftover collateral, and this is done through a collateral auction. To summarize, we have two different groups of users of the systems, which is number one, the DAI users. They just go to the exchange and get DAI and hold DAI for interest. And then number two, we also have the users who generate DAI through MakerVault, which is the lending protocol side of the system. And if DAI demand constantly exceeds DAI supply, it is a signal that Maker token holders need to adjust the stability fee. And an increase in the stability fee results in the higher cost of borrowing for Vault users, thus reducing the DAI supply by making Vault usage less attractive. Vice versa, a decrease in the stability fee will incentivize the additional creation of DAI, which acts as a policy tool to tweak supply growth. So stability fee is essentially just interest that you pay to borrow loans from the protocol. And this whole rebalancing method actually alters the incentives for vault owners to mint or burn DAI and can have a stabilizing effect on the soft peg. And this is how DAI actually keeps its peg. So when we first launched DAI back in 2017, the only collateral backing DAI is Ethereum. Today we have up to 35 different crypto assets backing DAI and tokenized real-world assets as well. Real-world assets become necessary at a large scale and the currency has to be tied to all aspects of the economies. It needs to be rely on other sectors and the major economies in the real world. And therefore, having real world assets, it helps balances out the risk of different assets in the protocol right now. And ideally, we want to have thousands of collaterals with different custodians, security models that sit in different jurisdictions. Today, we have about 35 different crypto collaterals, including Ethereum, Wrapped Bitcoin, which is just Bitcoin in the ERC20 standard, and then we have USDC stablecoin. We have other stablecoins in the system as well, and then we have Compound, Link, and a lot more different crypto assets. And then we have tokenized real world assets, for example, tokenized invoices and real estate. So the total circulation of DAI today is close to 6 billion. And just 1 year ago, as you can see in the chart, there was only 450 million DAI in the market. The growth rate for DAI is tremendous within DeFi space. Imagine when we add real world assets to the system, that's where you see how DAI will scale. We have another token called MKR token, which is our governance token. People who hold Maker tokens can vote on important decisions like the stability fee. Maker token holders are incentivized to govern to ensure a robust system, since Maker is the last resort of stability. If the system is not governed well, Maker will be diluted. If they govern well, Maker goes up in price. And then we also host a weekly scientific meeting to discuss metrics on DAI, how we can actually ensure the pack of DAI. The discussion also takes place on MakerDao forum, where community members put forth their proposals, which is then serve as a basis for polling and executive voting before any actual decisions are made to the system or implemented to the system. I've attached the links here. If you're interested, you can actually go to forum.makerdao.com to take a look at the different proposals. To summarize, these are the different stakeholders in the ecosystem. On the far left, we have the risk team that risk assess different collaterals that go into the system, because different collaterals have different risk categories. And then we also have the Maker token holders that vote on all these different like changes of risk parameters. And then on the top, we have the maintainers, we have the developers that build the smart contracts of the protocol, and then we also have an oracle team that maintains the price feed oracles. And then we also have like the keepers, which is usually incentive following bots that participate as bidders in the DAT auctions and collateral auctions when Maker vaults are liquidated. So they usually compete for profitable arbitraging opportunities created by the Maker system itself. And then on the far right, you have two groups of users. Like I mentioned before, we have the DAI users that just go to the exchange and buy DAI and use DAI and use DAI as a currency. And then we have the second group of users that mint DAI, which is the borrower of the system. I've talked a lot about how the protocol works, so let's dive deep into some use cases now. DAI is commonly used as the stablecoin in DeFi space. It is used to access different DeFi protocols in the space. And then DAI is also being used in social projects like disaster relief project. And then DAI is also used in countries that suffer hyperinflation issues because their own country currencies are way much more volatile than or Bitcoin or DAI. So the people would actually rather use a stablecoin rather than their own national currency. And we also have DAI integrated to like different business applications, for example, in the supply chain industry and also trade finance industry. So MakerDao is not just a creator of DAI stablecoin, but we are also a lending protocol, and we allow big institutions to borrow loans from us. For our treasury management solutions, if you're crypto asset custodians or crypto hedge fund managers, family office or crypto exchanges, what you can do is that you can now actually use Bitcoin or Ethereum as collaterals and borrow loans and stick it on other different DeFi protocols, for example, like Aave and also Compound, to generate high use to fund your company operations. And you can also use it, as to generate high yield generating products for your high net worth clients. So while decentralized finance continues to grow and attract mainstream attention, one area of lending that has the potential to vastly increase the size and scope of DeFi, and that area is known as real-world assets, which I mentioned earlier. And MakerDao has made the first step towards lending against real-world assets by partnering with a B2B tokenization platform for securitizing loans. To finance real estate loans and the US, and we continue to onboard more real-world assets, the different types of assets that dominate capital markets, for example, bonds, equities, commodities, and derivatives of all these different assets. And fractionalization is not new. It has already been, being applied to many different asset classes such as stocks and ETFs. The concept of fractionalization or securitization, of splitting up an asset class into portions or slices, such that they are smaller than a whole share, so that each fraction is thus cheaper and more accessible to investors. And now we're using this methodology to help small medium businesses to tokenize their loans and then use that as a collaterals to generate loans and DAI. So how is it done? A company brings a package of collaterals backing its loans to us, and these collaterals are put into a SPV, a special purpose vehicle, which isolates the risk from other assets from the asset's originator. And then Maker also built an integration rail with Centrifuge, which is our tokenization partner, which assists in the tokenization of SPV assets as NFTs, and which is non-fungible tokens. And then Maker then mints DAI against these NFTs pool that are placed into a Maker vault. And companies can then use DAI minted through this way to fund its loans in the platform. And yes, if you have any questions, feel free to reach out to me after this, or I'll be leaving my email and also my contact behind. But just before I wrap up the discussion, the talk itself, I would like to just talk about why use DAI. The reasons for using DAI generation from a partner's perspective are lower cost of capital, and because we are a protocol powered by smart contracts, we don't have a lot of overhead operational costs. We have that 60-70 people working on the protocol right now, and the protocol is actually generating a revenue of about 60 million per year. And and therefore if you were to use Maker protocol, we can promise you a lower cost of capital here. And then and also you can also increase your credit line with performance. We don't look at your past credit rating history, but basically just looking at the past performance, past debt paying performance, and then if you pay down your DAI loan, and you can also pay down your DAI loan as and when it is needed. Just to conclude, we're able to give cheap financing to companies. And yes, thank you. And for any business inquiries in Asia or outside of Asia, you can always write into me at Jocelyn@makergrowth.com, and my WeChat QR code is actually in the screen. Looking forward to hear from you, and thank you once again.